Today, our first meeting, finance ran over. Uh, It's now 10:51. I will call the Surgeon Water Board Pension Committee meeting to order. Special counsel, please call the roll.
Director Pacho.
Here.
Director Taylor.
Here.
Director Guzman.
Here.
Director Scholas.
Here.
Mr. Harold Heller. Mr. Kenneth Davis.
Here.
Ms. Rebecca Johnson. Mr. McDougal.
Here.
Mabusha McDougal. Chair, we have a quorum.
Right. Thank you. For the agenda, we have one presentation item this morning. This is the executive summary of January 2023, the market performance in 2023 outlook report. And we have Kweku Obed from Marquette and Associates. So at this time, Kweku, I'll turn it over to you.
Great. All right. Well, good morning, everyone. And we'll go through the January 2023 market environment. It will also set the stage and the expectations for the performance in the portfolio for the month of January. The good news is January was a really strong month, so the year began really, really well for the markets. As we know, the Fed is teeing up some more interest rate hikes. So interest rate hikes have had a pretty destabilizing effect on the markets. We've seen a lot of volatility in the markets, particularly in the months of February and March month to date. But year to date, the markets are still positive. So that's the good news I want to kind of convey when we talk about January and we talk about where the market is today. We're still positive year to date, which is a good thing. I mentioned the Fed, and this slide here, I think, does a really good job of just really capturing all of the, I guess, the attention and the noise that's going on in the market presently. So inflation, as we know, spiked up tremendously. The highest level we've seen in a generation in response to the stimulus that took place in 2020 and 2021 in response to COVID. So stimulus spending increases the money supply, an increase in money supply increases inflation. Inflation, again, is measured by CPI, the Consumer Price Index, which has gone up tremendously. To control inflation, interest rates have gone up. The Fed has hiked up interest rates 8 times. So we basically went from 0 interest rates back in the beginning of 2022. We're hovering just shy of 5% for short-term interest rates now. So pretty tremendous hike up in interest rates. And the goal there is for interest rates to go up. Spending will go down, and then with spending going down, inflation goes down. So that's really the relationship between the Fed and interest rates and inflation. Now, when we think about interest rates going up, there's been an impact on the markets, right? So rates go down, the market typically rallies, rates go up, the market typically will go through good bouts of volatility, especially in fixed income. Now, in the month of January, the expectation at the beginning of this year, and probably more of a hope than an expectation, was that the Fed would ease off a little bit with the interest rate hikes. And we naturally saw the fixed income market price this in, a pretty solid result of 3.1% for the month for the AG index. So again, expectations around interest rates not going up so much at the beginning of this year were a key driver behind these positive results we're seeing in fixed income. This slide here just measures the yield curve. So this is basically for each maturity level of the fixed income curve, you're going to get a sense of what the interest rate is. The big takeaway from this slide is the blue line. If you look at the inversion on the blue line, right, it's showing us that at the 0 or the shorter end curve, right now interest rates are higher there than they are going out to the 10-year, even further out. So that's an inverted yield curve. An inverted yield curve is typically a good predictor for an economic slowdown, because it does mean that current prospects for the market are priced more favorably than future prospects. So as we're talking about the economy, the portfolio, and the markets, I think one thing to keep in the back of our minds is these interest rate hikes and their eventual impact on the economy, which could be a slowdown, albeit a recession. So that's the takeaway there. The U.S. equity market started off really strongly in 2023. So we see the S&P up 6.3, mid-cap index up 8.3, and small-cap index up 9.7. I think the really interesting thing that this slide shows is the trend or the rotation in the market. So if we look at the one-year figure for the Russell 1000 value, it's down 40 basis points. The one-year figure for the Russell 1000 growth is down 16%. So it's that reminder that 2022 was definitely a tough year for growth stocks. Growth stocks, kind of like fixed income, are very sensitive to interest rates because growth companies, these are more levered, less cash flow, typically more on the tech side of things. So we definitely saw a big correction in growth, and value stocks held up well. Just to kind of go back before 2022, growth stocks were doing exceptionally well. So the FANG stocks, the Facebooks, the Apples, the Googles, and so on, the Amazons, these were leading the pack. But in 2022, we saw a rotation away from growth into value. On the non-US equity side, also a really strong start to the year. In fact, a little bit stronger than the start we saw in the US market. And really, these results here are also a good reminder that in this post-COVID era, we've definitely seen a spike up in correlation with respect to the movement of both the domestic and the international equity markets. The international markets are also facing many of the same pressures we are here. Central banks are also hawkish, looking to raise interest rates. These economies also faced record amounts of stimulus. And then, again, COVID, supply chain disruptions, and so on, these also impacted these global or non-US economies as well. So real estate here, this is just more of an FYI as we've discussed real estate and it's approved in the asset allocation. The takeaway here is real estate is a good diversifier. These are lagged asset classes, but last year when most other asset classes were in negative territory, real estate was one of the few areas of the market that had a positive result. Infrastructure is also captured in the same family of real assets. So infrastructure was also a good diversifier, as was private equity. So these are just more FYI slides as opposed to anything to really dwell on. So this takes us to our portfolio for the month of January. As I noted earlier, a really, really good start to the year for the markets and naturally for us. If we look at the portfolio has done well, really well versus the index, as well as on an absolute basis. The dark gray line represents the portfolio. The lighter sand color represents the index. And you will see here over all periods measured, we have outperformed. So that's, again, a good distribution of returns for the portfolio. As we look at the various composites within the portfolio, we do see, for the month, the fixed income composite held up well, equities held up well. The alternatives composite, just a reminder here, this is the hedge fund allocation. This has been liquidated, but we're still looking, out to, approximately 1 year before everything is redeemed from the hedge fund. And then the real estate composite is REITs, real estate investment trusts. These are liquid, daily traded securities. So all in all, a really nice start to the year, very strong returns across the various composites. And as we think about the performance, we highlight some of the top performers, some of the bottom performers. The bottom performer here, really points to how times have changed. It's a 10 basis point differential. This is an index fund, so nothing really to report on there. And then the outperformance from Pyramis and Earnest Partners came from true active management in those strategies. Now, the asset allocation versus the target asset allocation, you will see here that we are overweight in some segments by a small amount, and then underweight in some segments, particularly private equity, by a slightly larger amount. And this takes us to...
Excuse me.
Yes.
Go back to the previous slide.
Yes.
So if the real estate and infrastructures are outperforming any other portfolio,
Yes.
so why are we not putting more money in those?
Yeah, so that's a good question. With real estate, global infrastructure, and private equity, these were newly adopted within the portfolio. the next section, I'm actually teeing up a timeline for us to get into those strategies. So that is being dealt with, and with any change in asset allocation, it can take a number of quarters to go from where you were to the approved asset allocation. So again, this is just part of the transition we're going through.
So are we tied up with any contractual obligation to keep the fund for a certain period of time in a certain?
So for the private equity, we will be. For the real estate and infrastructure, these will be what they call open-end vehicles. So these will be relatively more liquid, but you're still looking at a couple of quarters to get your money. For the private equity, that's structured a little different. So private equity, typically you're going to look at an 8-year investment period, and then let's say a 2-3 year harvesting period where they redistribute the money back. It could be a little longer, it could be a little shorter depending on the vintage year. But yes, ultimately you're looking at a lot less liquidity with the private equity, slightly less liquidity with the infrastructure and real estate, and ultimately the private equity allocation won't represent, it will be a material portion of the portfolio, but it won't impact our liquidity in terms of making benefit payments and just having enough cash on hand. So the goal there is for it to be a long-term diversifier for us.
Okay.
Yep. And I want to give a shout out to my my analyst for actually putting this useful exhibit together. As we think about the portfolio, and we haven't added private equity, we haven't added infrastructure yet, but there have been a lot of changes in the portfolio. So here we just highlight, for example, when the asset allocation was approved. So, in November of 2021, the investment policy statement was updated, shortly after that. And then actions that have been taken on managers within the portfolio in terms of hiring and terminations. Just as a...
Okay, just want to go back.
Yes.
In terms of those new managers,
Yes.
can you give us just a quick snippet of the intent in terms of an issue that continues to come up with this committee in terms of diversity and so forth?
Absolutely. Absolutely.
Okay.
Yeah, so with the new managers listed here, the good news is, these new managers, these are passive exposures, primarily with the exception of Cohen and Steers, which is a placeholder. So the diverse managers that we are looking for and the diverse managers we're going to put and recommend to you, these will be coming in the next wave, and some of those managers will actually be replacing some of those index exposures. So the index exposures were really there to just help us move to the asset allocation a little bit quicker. But as we start looking at long-term active managers to either complement or replace some of the passive exposures, my research team is working on a list of just best-in-class, diverse-owned entities, going from the equity side, the fixed income side, and then even on the private equity side. So we have some really good diverse-owned firms that are not only diverse-owned, but they really are best-in-class in what they do. And that's what we will be putting in front of you when we're deliberating about the active managers we want to hire and put in the portfolio. Okay. So that will be coming, and that will be in a search document. And the goal will be to highlight the search document with you. I'll probably have a colleague from research also talk about the merits of the managers. And again, the mandate or the goal or the objective of making sure that we have more than adequate diverse representation in the portfolio. You will definitely see that when we bring the candidates to you. So, being a best-in-class, top-performing portfolio, having diverse managers, that's not mutually exclusive in my opinion. So again, we will be bringing those managers to you, and the goal is to have a best-performing portfolio that just kind of stands out there.
When you say best-performing portfolios on these managers, how do you assess that?
Yeah, so we have
how far back you go?
So with managers, we look at their historical track record.
How far back?
Since inception. So it'll be since inception, but beyond looking at since inception returns, you also want to gauge whether the manager's success in the past, whether they have structured a process or a framework that allows them to replicate that going forward. So we do look backwards, but we also look forwards, thinking about the market, interest rate environments, supply chain disruptions, global conflict, and how those managers would perform in that type of environment. So it's definitely quantitative, but there is a qualitative approach to how we look at the managers. And any manager we recommend, you will see exhaustive analysis in a search book that you guys will all have, and that will be good documentation around some of the key characteristics that have been looked at, discussed. And again, it's performance, it's risk, it's fees, it's portfolio allocation, stability of the team. All of those things are factored into who we look at before we put them in a portfolio.
Most of these managers are from US?
Yeah, particularly diverse owned. So while the planet is diverse, I would say the US has been the leading country in terms of having diverse asset managers actually own and operate their own firms. So predominantly US, I won't throw out any names because this is a live meeting and you guys will get harassed by managers, but there are definitely good managers, US focused. And again, we'll take it from there once you guys have the names in front of you. But again, my job as a fiduciary is to put the best-in-class managers that we feel will do the best job for you. And again, giving the direction you passed along regarding the composition of the managers, their approach to looking at the world and so on, we're making sure that we're factoring in all of that before we put those managers in front of you.
Thank you.
Yep. So this is just a quick recap of the asset allocation. So nothing to really rehash there. It just shows where we were in the past, where we are going to today. And then with the asset allocation, there's typically a plus minus 5% overweight, underweight we're allowed on the ranges. That just allows for market movement and doesn't force us to rebalance all the time. Now, these slides are super helpful as well. These are just for your back pocket. It just points to transactions that have taken place in the portfolio. So nothing for you to do. It's color-coded. So basically what's in red points to what was liquidated. What's in green points to what was purchased in the portfolio. And everything is in accordance to the approved asset allocation and the recommendation that was put forward and approved a couple of months ago. So here we've just discussed, the infrastructure and real estate. Here is the U.S. large cap equity part of the portfolio. Here is mid and small cap in terms of liquidations and fundings. And then overall, this is a really busy chart, so I'm not going to go through it, but just for your notes, 10 years from now, if anyone's looking back, this is just going to show that we, very thoughtfully showed where the money's going to go, where the money's going to stay as a placeholder, and where the money's going to be long-term. So again, the color coding just points to all of that. Now, this takes us to searches, and in terms of searches, there are a couple of things that we would want to propose today. So firstly, given the nature of private equity, we do feel that having private equity, infrastructure, and real estate as the first round of searches we bring to you, that would be what we recommend. And then also just to keep the asset allocation process moving, we currently would recommend going into index funds for the non-US small cap and emerging markets, just for short-term proxy exposure. And that would also give us time to search for the appropriate active managers for you. So just to repeat, a lot of things on this page, but private equity, private real estate, global infrastructure, these are the three areas we'd want to bring to you first in terms of recommending managers and candidates. And then on the non-US small cap and the emerging market side, we would want to put us in index funds, again, just so we have market or beta exposure. And then we would concurrently with the US mid-cap, US small cap, core fixed income, and other searches, put forward active managers for your consideration. So that's really the recommendation here around.
What's the percentage of the total on the non-US small cap and emerging markets?
Yeah, so I will take us here. Okay, so everything is listed here. Apologies for the small print, but 3% in emerging markets and 3% in non-US small cap. So
And
that,
thank you for the record. We'd like to note that Rebecca Jonesy is in attendance.
well, that would conclude my comments. So really, again, January, really good month for the portfolio. Year to date, it's only March, but it's already been an exciting year. The Fed is determined to really raise interest rates. So, the market continues to be, extremely volatile. And as we think about the asset allocation, once again, the asset classes we're looking to add, the asset classes we're looking to have passive exposure to over the long term, again, the expectation is to get us in the best position to consistently hit that target rate of return.
So did your projections include the most recent statements from the Fed?
So, long story short, yeah, the projections will include. So there's a stochastic analysis behind the numbers, and it will include regimes where interest rates go up, interest rates go down, but everything basically normalizes over a 10-year period, because what the Fed is doing now is extreme, and it will, at some point, rates will have to come down again. So it's a long way of saying we look at distributions around the tail. So we look at 5th to the 95th percentile for every single asset class, and the returns corresponding with that right now do take into account just interest rates, because interest rates are a building block around how we value other asset classes. So yes, that was a long way of saying yes.
And what's the timeline again for the recommendations for the managing partners?
So the timeline here would be I will answer your question with a question first of all. So with the emerging markets and non-US small cap, because these are going into index funds, I still believe that we would have to make there would have to be a recommendation that's formally written out. We send it to Gray, and then that's approved. So whatever timing of that works for you, we'll accommodate that. So as quickly as you want to do that, we can get the verbiage to you, so that can get approved. And then from the remaining standpoint for the searches, I would say within the next quarter, if not significantly sooner, we'd have the alternative searches ready for you. And then the other searches, they would literally just be off the back of the alternative searches. So maybe another 2 months after we've gone through alternatives. The reason why we've looked to pace it out that way is just not to overwhelm everyone. I think a lot of important decisions are going to be made around the managers, particularly private equity, the nuances of it. So we didn't want to inundate you with so much information that we couldn't get all the questions or field as many questions from you as possible. So again, we would think over the next quarter we would look to conclude the alternative searches, and then shortly after that, we would also look to wrap up the traditional searches, which would be U.S. mid-cap, U.S. small cap, core fixed income, emerging markets, and non-U.S. small cap.
Okay. That's it?
That is it from me.
I had a question, but I think it might be for Gray. I understand that this presentation, and I read it last night, so I apologize that I was late today, but involves the financial health of the fund. But how do we get information on the metrics of our usage, right? Participants, average payouts. Where is that kind of information?
The actuarial firm Rudd & Wisdom does the annual valuation every year, and so that includes participant counts and average payment. So that's underway right now. The measurement date is January 1, 2023. So the benefits team is assisting with that process. So they'll be doing their calculations, evaluations that are required for our audited statements in the March-April timeframe, and then they shortly after that they do the contribution study for fiscal 23 and come to the committee and do the presentation in the kind of the late May, early summer. So that's sort of the the pattern there.
Okay.
And they present every year annually with those numbers that you're requesting.
Okay. There was one information item.
There's one information item, and that's the January 2023 Supplemental Performance Report from Marquette and Associates.
Okay.
And.
Any public comment?
Public comment, Chair?
Thank you, Quaco, again.
Okay, thank you.
No public comment, then I'll entertain a motion for adjournment.
So moved.
Oh, and
Second.
also, we just, I'm sorry, we have Jesse Evans from the city.
How you doing?
And
Jesse,
just-
the City of Norris Employee Retirement System. So we are sister brother plans, so we do have a reciprocal agreement between plans. I'm not sure if everyone's aware of that. It allows for the free movement of employees between the systems at no cost to the members. So we're always interested in what you guys are doing. Want to make our plans as close as possible, but happy to sit on the meeting this morning.
Thank you for being here.
Thank you, Jesse.
Okay, we have a motion. Do we have a second? Second, we have a motion to second. All in favor? Aye. Motion carries. Thank you so much. And again, apologize for the lateness in starting the meeting.
Again.